It's been a turbulent year so far for the IPO market. In just 1 week, both Clearstreet and Liftoff postponed plans to go public, citing market conditions. Meanwhile, Solv Energy, which is owned by private equity firm American Securities, was able to complete its IPO and raised $513 million. I'm pleased to say joining us now is the American Securities founder and CEO, Michael Fisch. Michael, thanks so much for joining this morning. So you IPO'd last week, again, in a week where we did see others back off. Was there ever a moment where you looked at the market volatility and thought, maybe we should do the same, maybe we should postpone this?
Never. Solv is a terrific company. It's got an amazing CEO, George Hirschman, and his management team, and a significant backlog in a growing sector. Some call it energy transition, we call it energy addition. And Solv is the largest solar EPC, so it's built over 20 gigawatts, enough power to do all of LA's homes for a year, and a backlog that keeps growing on the back of the need for more energy for data centers, for the reindustrialization of America and other things. And solar, as you probably know, is the cheapest, fastest way to construct power. You don't have 2 to 4 year waits for turbines and things like that. And the sun's shining every day, particularly in parts of this country. And battery storage is so great now, it's now a real option for many grids.
The sun's also shining metaphorically for Solv too. I mean, so far it's already up nearly 30% since its public debut. So what is the distinguishing factor between a company that you can bring to this public market right now and one that you can't because of the volatility we've seen?
Well, I think, company industry management always matters. And in Solv, as I said, people saw a great demand for many years to come in the need to build more power in this country, and solar being a great place for that, and Solv being the #1 player in that space. And so with backlogs and growing revenue and EBITDA, people saw stability in the midst of turmoil in other sectors. And we were delighted with Jefferies and JP Morgan, our lead underwriters, and the management team did a terrific job talking to investors.
Now, I was speaking with TPG's CEO, who basically said that a lot of funds have left themselves with companies where the only exit route is an IPO. Maybe they're too big for a strategic buyer. I know for you, certainly, IPO is not the only exit route. You sold foundation building materials for Lowe's, $8.8 billion in cash at the end of last year. How are you viewing your exit options? Is the market pretty wide open for both strategic buyers and IPOs for the companies that you're currently holding?
As a general statement, the market factors matter, as you're talking about, Dani, but if you've got a good company with stable long-term demand, a great management team, there's always an exit at the right price, if that price makes sense for you and your investors. And so we, in 4 situations last year, returned $2.6 billion to investors. As you said, now Solv is a $6 billion market cap, and we're delighted to own about 73% of that. So there's always opportunities if you're buying great companies with great management teams with long-term stable demand.
Do you think that is a fair statement, though, that some funds haven't fully thought through the exit, that when they were buying companies at high multiples in 2021, 2022, they hadn't really thought about what happens 5 years down the road?
Well, I don't know that they didn't think about it then, and they're sure thinking about it now. I mean, as you're highlighting, the headwinds for exits have been the higher interest rates in the last 5 years, from virtually 0 base rates to now 5%. So if you borrowed to buy a company 5 years ago, you paid about 5-6% interest, and now that's 10 or 11 if you can get it. And multiples being double digits. If you haven't seen growth, that's a problem. And now there's probably there's estimated by one consulting firm to be 16,000 companies in private equity portfolios, and over 70% have been held for more than 5 years. So those companies need an exit. That, I think, will unwind itself in the next 12 to 24 months as those initial financings come undone. They just run out of time, and so they've got to sell or they've got to refinance. Some will do a bit of both. And we think that's a great opportunity for industrials in the next period, and a great time for us as the U.S. reindustrializes.